Okay, today I'm going to try and go a little bit slower. This is a very important hour in the whole concept of options and option trading. And in this course, this is probably one of the most important hours. The hour that we're going to talk about now is called synthetic options. We'll get into that in a minute. Let's go back a little bit and talk about calls, puts, intrinsic value, time value, and delta. So when last hour when we talked about the makeup of the price of an option, it started with intrinsic value plus time value. That gave us the actual price of the option. So when they told us an option was worth 20 cents, we were able to break up the intrinsic value component of it and the time value component of it, add them together, and that gave us the total value. We understand that when we talk about intrinsic value, the strike price of a call has to be below the futures price. That gives you intrinsic value to the call option. The put option will have zero intrinsic value because the strike price is below the futures price, and no one is going to want to sell that underlying commodity at a cheaper price than it is trading in the actual market. So there is no intrinsic value. So the put value only has a time value component, whereas the call had the intrinsic value plus the time value. And what we know is that the time value is the same for the call and the put in the same strike. Again, it has to be in the same strike. We can't, in the next hour, we cannot talk about puts and calls in different strikes. Everything has to be in the same strike. So if you're talking about a $6 corn call, the properties that a $6 corn call has are exactly the same as the properties that a $6 put have. Again, I keep pounding this because it's so important. It has to be in the same strike. If you start looking at different strikes, you're not going to come up with the right answers, and you're going to get yourself really confused. It has to be in the same strike. The next thing we talked about was the delta, and the delta being the probability that that option will go in the money. Now, the easiest one to talk about and to understand is one that is right at the money. If you have a $6 call, a $6 put, and the futures are right at $6, and I put a gun to your head and I say the next tick, you can either have the call or the put. Which one do you want? You can't make that decision because that decision is basically a coin flip. It could be the next tick could be up and the call will be in the money. The next tick could be down and the put will be in the money. So you can't make that that dissemination between those two. So the probability that that option is going to go in the money is 50%. It has a 50% chance of going in the money. That delta is 50. It's half of a future. And the delta in the put is also 50% or half of a future. Again, when we talked about these things last hour, we talked about the total delta always adding up to 1. And when you looked at that graph that I suggest you take it and laminate it and put it on your desk, where you see the array of options from the in the money call option to the out of the money call option, how the delta changes from 100 to 0. And on the flip side, the put in the money put has a delta of 100 to the way out of the money put having a delta of 0. That little array is going to help you quite a bit when you're starting to reference things as you're trading. And it doesn't do you any harm to have that little cheat sheet laminated and taped to your desk while you're trading. I highly recommend it because it'll make things a lot easier when people start talking about out of the money options and in the money options and whatnot. So I recommend that. And just go back an hour and look at the array that I drew up. And you can do it for any commodity. Do it for crude oil, do it for sugar, do it for cotton, cocoa, soybeans. It doesn't matter. If you're even trading stock, do it for stocks. For an example, if you want to look at stocks, take a look at Tesla. Tesla's trading $200. So the $200 call will have a delta of 50. The $200 put will have a delta of 50. And then build it out from there. The strike prices of a $100 Tesla stock, what does that have? Well, it has $100 of intrinsic value because the strike price is $100 below the futures price. This option course that we're teaching doesn't just count for ag options. You can use this for every single option out there. Options on stock, options on bonds, options on all commodities. So once you learn this backwards and forwards, you can apply this to anything. So that being said, here comes the real fun part. And I like this. So this will be really easy for me to talk about. I'll probably go way long, but I'm going to try and go really slow for you because it's really important. And it is fun. Once it clicks, you're like, oh, wow, this is really cool. What we're going to talk about today are synthetic options. We're going to take a call option and we're going to turn it into a put. And we're going to take a put, we're going to turn it into a call. And then we're going to take puts and calls together and we're going to turn them into futures. This sets up for price discovery that you'll find. You'll be able to find arbitrage situations, and we'll get into that in the last half of this hour, where you'll find mispriced options quite easily. And then it just becomes confidence in what you're doing. Once you're confident, you know what a synthetic is, and you're doing it correctly, and the math is right. You'll see opportunities and options are being mispriced and be able to take advantage of them. So let's get started. What we will do is we will take a regular call option and we'll call it, let's stick with soybeans and we'll stick with a $13 strike. So the futures are $13. I'm going to make the first one easy. We're going to go through a bunch of these examples just so you can see how it works with the delta. You have to incorporate the delta into this. So the easiest one to do is at the money with a 50 delta. So let's start with futures of $13 and a $13 call option. We know that the delta, when I write that triangle represents delta. And when you see it on our logo, Delta House with the triangle, that's what the triangle stands for, is delta. When you see it on all the trading platforms and trading things, you'll see that triangle, that means delta. So the delta of that $13 call, and if you guys were in the audience, I'd ask somebody to tell me, and I'm sure every single person would know the delta because we pounded it for 2 days, is 50. And the $13 put has a delta of 50. Now, let's go back a little bit, just so I make sure you guys got this right. $13 call with the futures at $13 has absolutely how much intrinsic value? How much is it in the money? Is this $13 strike below the futures price of $13? The answer is no. Is it above it? The answer is no. It's right at it. So this $13 call option has intrinsic value of 0. I'll put IV for intrinsic value plus TV for time value. And we'll call it 25 cents of time value. Okay. So the $13 put, it has 0 intrinsic value and has 25 cents of time value because why? Because we know that the calls and puts in the same strike have the same time value. Now, let's do our math. First, we'll do our math, and then we'll get into. I'll give two of the 3 components, and we'll build the other one. Okay. The other thing I want to go back on, a future represents one full delta. That's 100%, which is a call option, a put option, are 50% of that. So if you take the $13 strike and you take the value of the call and you subtract the value of the put, you come up with 0. If you take this number and you add it to the $13 strike, you'll get where the futures are. So if you take $13 strike plus 0, the difference between the premium in the call and the premium in the put, and you get 0, you get $13. That is the futures. Okay, I'm going to change the prices for just a second so you guys understand what I'm saying. So let's say in our second example, the $13 call has a value of 40 cents. And the $13 put has a value of 25 cents, just like above. If we take the 40 cents and we minus the 25 cents, we have 15 cents. What does that 15 cents represent? It represents the intrinsic value. It's the same thing. Intrinsic value plus time value equals the price of the option. So in the call, 40 cents had 15 cents of intrinsic value and 25 cents of time value for a total of 40 cents. Now you understand why that call and put premium is in the time value is so important, that you understand that that's the same. You can quickly figure out where the intrinsic value is. In this case, it's in the call. So this is positive 15 cents. So if we add 15 cents to the $13 strike, we get $13.15. That would be the price of the futures. If the calls were trading 40 cents and the puts were trading 25 cents, the futures would be fairly valued at $13.15. That's the intrinsic value of between the calls and the puts. And since you're paying 25 cents of time premium and you're collecting 25 cents of time premium, that is a wash. Now let's check our math one more time. So a $13 call has a delta of positive 50, because when you buy calls, that is a bullish position, and we want the market to go up. So you're long 0.5 of a delta. You're long half of a future. The $13 put, if we sell that, it also has a delta of 0.5. A long delta. Remember, selling puts gets you long. And the delta equivalent of a $13 at the money put with the futures at $13 is 50. So that is also a long delta of 50. If you add those together, that comes up to one full delta. One full delta equals a future. Now that's really, really important, because as we said before, buying and selling, as we said before, the deltas of the calls and the puts always add up to 100 in the same strike. We're just using at the money right now because it's the easiest. I'm going to take this page out and leave it over here as a reference. Now, as the delta changes, that does not mean that the intrinsic value changes. It just means that the futures are changing. Remember, delta changes as futures change. Look at your little cheat sheet on your desktop. The deeper in the money, the greater the delta of the call. So it changes as it goes to at the money. It goes from long 1 to long 0.5. As it goes out of the money, it goes from long 0.5 to 0. So let's go to where we only have two components, okay? And I'm getting a little bit ahead of myself here, but how you handle the time premium part of the options is really, really important. But let's just slow down a little bit and go to where we take two of the components and it tells us what the third one is. I'm gonna go with the hard one first. If we know what the futures are, okay, the futures are, we'll just use our examples because it's easy. $13.15. And someone tells us that the calls are 40 cents. What are the $13 puts? Those are intrinsic value plus time value, which equals, we know the call has 15 cents of intrinsic value, which means the put has 0. So the put has 0 intrinsic value plus 25 cents of call value. So we figured out by having two what the price of the third one is. Now here's where it gets fun. We're going to turn one of them into the other. So I'm going to elaborate on this a little bit. Just for this example, because it's in the money, we're going to use 60 and 40 as the delta. And since the call is in the money and has intrinsic value, we will assign that a 60 delta, and we'll assign the put a 40 delta. Again, what do they add up to? They add up to 100, 1.0. What does 1.0 equal? A future. Now, what we're going to create here, and it's the hardest one, is a synthetic put. Okay? So, if we take a $13 call and we buy it for 40 cents, that is long a delta of 0.6. We're trying to create a delta of negative 0.4 because if we're long a put, we want to have a short position of 40% of a future. How do we do that? Okay, we take the $13 call. We can buy it. We're buying a call. We're buying a call that is going to look like a put when we're done. But keep in mind, if we're going to create a synthetic option, we have to start with the same thing. So if we want to have a synthetic short put, we have to start with selling calls. If we want to have a synthetic long call, we have to start with a long put. They have to be the same. You have to start with the same thing. If you want to create a short option, you have to start with the short on the other side. In this case, we want to create a long put. So if we take the $13 call for 40 cents and we're long 0.6, we're trying to get to negative 0.4. If we sell one future at $13.15, that has a short delta of 1. Remember, futures have 100 delta. So selling one has a short delta of 1. So if you take a short delta of 1 and a long delta of 0.6, you get a short delta of 0.4. Well, what is a short 0.4 delta? That is a $13 put. So you've created, by buying a call and selling a future, you've created a synthetic short or synthetic long call. A synthetic. See, I even get the stuff wrong sometimes, so I get ahead of myself. A synthetic long put. Okay, this thing works exactly the same as just buying a put. So if you look at that, you've got $13.15, and you've got 40 cents of call value. So the call has 15 cents of intrinsic value, and the calls, you paid 40 cents for it, which means you paid time value of 25 cents. So this is a synthetic short put. Now we understand that the deltas of the calls and puts have to add up to 1, and that a future adds up to 1. Let's get into what synthetics are, okay? We talked about 3 synthetics. Well, we have 3 products. We have a call. Well, you can buy a call, you can buy a put, or you can buy a future. And you can sell a call, sell a put, or sell a future. We have 3 products. Well, if we take 2 of those products, we can create the other one. And that's what we're trying to do here, okay? It'll get you a lot more comfortable with puts in general. So a synthetic long future. A synthetic long future has a delta equivalent of 1, because a future has a delta of 1. So a synthetic long future. Now, when you hear people talk about synthetics and you hear them talk about long, it doesn't matter if it's a long call, long put, or long future. The option has to start with a long side to it. So synthetic long future has a delta of 1. What part of this, again, this doesn't matter what strike you use. It just matters that they're in the same strike. So for our example, just to keep it simple, we're going to use those 50 delta options, those at-the-money options. So what has a component of being long the market of half a delta? Well, that would be a long call. Okay? A long call has a delta of 0.5. Long. Now, does 0.5 equal 1? It does not. We need another component. We need another half of a future. We're going to get a half of a future with options. Again, it has to be the same strike. Well, we could buy a put, but that won't get us a long half delta. That will get us a short half delta. And if we buy a call and we sell a put, that offsets. We would have a half long delta and a short half delta. We have 0. 0 does not equal 1. So in order for us to get a long 1 delta, we would have to sell the put. That delta is long 0.5. That equals 1. That equals a future. So a synthetic long future is a long call and a short put in the same strike. Again, it doesn't matter. Just our example, we're using the 50 deltas. Let's take the 75 delta and the 25 delta option. If we wanted to create a long future, synthetic long future, it would be a long 75 delta call and short a 25 delta put. Check your math if you need to. More and more you do it, it will become very, very routine. But in the beginning, check your math. I bought a 75 delta call. I sold a 25 delta put. That equals 1. 1 is a full future. It's the exact same thing as buying a future. It will have the same, it will act the same in the marketplace as a long future. So now we can do the short future. That should be very simple. It's just the exact opposite of what we just did. So synthetic short future would be selling that at the money call, that 50 delta call, and buying the 50 delta put. That would be a synthetic short future. So that those are the two things you can do with futures. You can only buy futures and sell futures. So you can either do that or you can use synthetics, but that's the only thing we can do with synthetics. And we did that with calls and puts. We didn't touch the futures. All we did is we created a product that works exactly the same as the actual product using options. We bought a call, we sold a put. That was a long future. We sold a call and bought a put. That was a short future. We created a synthetic futures position through options. Okay? Now let's create synthetic option positions. Let's create a synthetic long call. Now, this is where it gets really good, because this is where you're going to find you're overpaying for things because, order flow comes into the calls, and when we go through the numerical example, it'll become a lot clearer. But if the order flows in the calls and there's sort of resting orders in the puts, you can create a synthetic long call. You can create buying the call cheaper than you actually can in the marketplace, and that's actually really, really cool. So a synthetic long call, you would buy a put, an at-the-money put, which has a delta of negative 0.5, correct? Because it's a short position, so it's got a negative delta. What are we trying to create? We're trying to create a synthetic long call, which is a long delta of 0.5. Well, we just bought a put. That gives us a delta of negative 0.5. That's going to short the market. We're trying to get long. So how do we offset that 50 delta short put with something that'll give us long one? Well, we need to add one, right? So we will buy a future that has a delta of positive 1. The delta of 1 in the future minus the delta of half in the put gives us a delta of 0.5. That is the exact same as a delta of a long call. We took a put, we bought a future, we created a synthetic long call. Now here's something that's really important. You can't do it with different quantities. It has to be 1 to 1 to 1. You cannot create synthetics by buying 2 puts and buying 1 future. That doesn't work. And when you do the math, you can see if I bought 2 of these puts, that would be a negative 1 delta. And if we bought a future, that'd be 1 delta. That does not equal the delta of a call. That just washes out into 0. We're looking to create a 0.5 long position. So it has to be 1 to 1 to 1. And again, it has to be in the same strike. You can't buy a 1350 call and sell a 1250 put and create a future. It doesn't work that way. They have to be in the same strike because, as we know, the delta of the future is 1, and the only way you're going to get the delta of 100 is in the calls and the puts in the same strike. So let's take a look at the synthetic short call. Now, you can't create synthetic options with options that are long have different properties than options that are short. Remember, when we buy options, we have limited loss and unlimited profitability. You cannot create a synthetic long call or a synthetic long put by selling options, because when we sell options, the most we can make is what we sell them for. So we have limited profitability and unlimited loss. So when you first thing that comes into your head is if you're trying to create a synthetic long call or put, you've got to start with the long opposite side, because and this goes back to the time premium. The time value has all the properties of the option that make them change with volatility, delta. Those have to be the same. You can't be having different time values and create a synthetic. So a synthetic short call, you're going to start with a short put, one short put. Now, a short put is a long position in the marketplace. That short put is going to have a delta of 0.5, a long delta of 0.5. I'm using at the money, giving it a 0.5. As soon as I'm done with this example, I'll give an in the money option and show you how we can create the same sort of thing with in the money. But for right now, let's just use at the money. We're trying to create a negative delta of 0.5, but we already have a long delta of 0.5 by selling the put. How do we offset that and flip it the other way so we have a negative delta? Well, we know that the futures have a 1 delta. So we sell one future. That is a negative 1 delta. That gives us a negative 0.5 result. What is the delta of a short call? Negative 0.5. We have now created a synthetic short call. Before I get into the other examples, I'm going to go over the puts. Since we just did the calls, the puts are going to be very similar. They should be pretty easy. So, if we're going to create a synthetic long put, what do you think we're going to start out with? Well, I heard someone in the crowd out in Iowa that just said it's going to be where I start with a put. So we're trying to create a synthetic long put. So the first thing we're going to start with is a long call. Now, the synthetic long put has a delta of negative 0.5. It has a 50% probability that it's going to go in the money. If you see this if you see a delta of 0.5, what's the first thing that should come into your head? Automatically, it should be that's where the futures are. That's right at the money. So we're creating a synthetic long put that has a delta of minus 0.5. We know that put is at the money. So to create that put, we buy a call, but that has a positive 0.5 delta. That's a long position in the market. You want the market to go up. But we're looking to create something where we want the market to go down. So to create that position, we need to sell one full future. That gives us a negative 0.5 or negative 1 delta. And you take the difference of the two and we create that negative 0.5 delta that we're looking for in the put. So a long call with a short future gives us a synthetic short put. The last one we're going to talk about is a synthetic short put. Now, a synthetic short put has a delta of 0.5 to the upside, but it's a short option, so you're limited to the amount that you can sell it for your profitability. So how do we create that with a call? we have to start on the short side of calls. So we start with a short call in the same strike. That gives us a negative 0.5 delta. Even though we're trying to create a positive 0.5 delta, we would hedge that by buying one future. Again, this all has to be 1 to 1 to 1. If we do 10 puts, we have to do 10 calls, and then we have to do 10 futures. And they're going to create 10 synthetics, okay? So if we buy one future that has a positive 1 delta, and take the difference of the two, and that's a positive 0.5, and that is the delta of a short put. So now we've created, by using calls and puts, we've created synthetic futures. Buying and selling both options, you're going to create a future. Now think about that for a second. Futures do not have any option properties. They're not subjective to time value. They're not subjective to volatility going up and down. They don't change in price. If volatility goes up, it doesn't matter. The only thing that matters is that the price goes up or down. There's no properties. There's no theta. There's no gamma. There's no vega. There's no component to a future. So when you create a synthetic future, the options have to offset because they have properties in them. So if you have positive properties with a long call, you have to offset those properties, the time value, with a short put. Again, so we have a long call, a short put. Long 0.5, short put is long 0.5, a long call, a short put equals a future. So we can create a synthetic future. Same thing with the other side. Now, when we start creating synthetic options, we want to create option properties because if you're looking to buy, that's what you're looking for. You're looking for the gamma, theta, vega. You're looking for all of them. You find those to be undervalued. So when you create a synthetic long call, you buy a put and you buy a future. The put having a negative 0.5 delta and the future having a positive 0.5 delta will create the same position as a synthetic long call. Now, why is that important? That's important because in a lot of commodities, and I'm using eggs for example, the puts will trade at a discount to the calls. So if I'm looking to buy and at the money call, let's take a look at that. If the call is 40 cents, well, let's look at the one that's in the money. The call is 40 cents and the put is 25 cents. We know the futures have to be 13.15. If this we know this to be true, this actually is fair value. There's no advantage to doing anything here. The call has 15 cents of intrinsic value. It has 25 cents of time value. The put has 25 cents of time value. And the futures are, the call is in the money by 15 cents, which is equivalent to the intrinsic value. There's no advantage to doing any one of the three here. So I'm going to show you where things get mispriced, and it is advantageous to trade the put instead of the call. So let's say they'll never trade this wide, but I'm going to give you examples so it's so glaring you pick it up easy. So let's say the call, first of all, the most important part is the future. And the call is trading 40 cents. But someone is offering the puts at 20 cents. Okay? You looked at that and you're like, okay, well, the first thing that should pop out at you is the difference between the call and the put, which is the intrinsic value, is 20 cents. You add 20 cents to the call because it's in the money. The futures, the calls are more expensive than the puts, so the strike price is below the futures price. You add that to the call strike, and we're actually trading $13.20. So when you want to sell futures at $13.20, if you can buy them at $13.15, the answer to that question is yes. So how do you do that? Well, we go back to our synthetics. if we buy a $13 put for 20 cents and we sell $13 call at 40 cents, and then we buy the futures at $13.15. We have created a synthetic, this component right here is your synthetic short future. We have a short delta of 0.5 in the put, we have a delta of 0.5 short in the call, and the intrinsic value is 20 cents. So we bought futures in the open market at $13.15, and we sold a synthetic future at $13.20. That happens a lot in the pit, and it does happen on the screen quite a bit. It's not going to be 5 cents. You're not going to make 5 cents on it, but you'll see opportunities like that all the time. And if you have the confidence to look at that and recognize the opportunity, you're like, yeah, boom, 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 and you'll lock in that 1 cent or half cent. You just have to make sure that in the slippage of everything, one doesn't get away from you. More importantly for us, when we trade these options, is we're looking for opportunities to buy options at cheaper volatility than the trading in the piss or on a skim. In this situation, we know with the futures at $13.15 and the calls are valued at 40 cents. I'm going to go through this slowly. The intrinsic value is 15 cents. The time value is 25 cents. We know that the put has to be worth 25 cents, but we want to buy it cheaper. We don't really want to just take the 5 cents because we think there's a lot more opportunity in buying these puts and scalping the properties. We'll get into this in hours 4 and 5 and in course 2. But we're looking to buy cheap options. And now we're able to buy the options cheaper than they're trading outright. So we're this put through the call is worth 25 cents. If we can buy these puts in the open market at 20 cents, we can then buy the futures at $13.15. So we are, in turn, we have intrinsic value that never changes of 15 cents plus 20 cents of time value that we paid. We paid 20 cents for the time value. That equals a 35-cent call. Again, 1 to 1 to 1. We just bought calls that were trading 40 cents for 35 cents. We want to maintain that in our position because we feel that even at 40 cents they were cheap, but we're not just satisfied with buying cheap options. And this is why I'm doing this course. I can find you cheap options all over the place, but once I find you a cheap option, I want to be able to find the cheapest of cheap. Here's one way. We look at the synthetics. We look at the money call and put, and we figure out which one is more expensive. It might only be by the smallest amount. It might only be 1/4 cent different. But think about that. If you can save 1/4 cent on every single option you trade, that's $12.50. When your brokerage is $25, that makes a big difference. Now you're in the ballgame and your brokerage is eating you alive. So every little bit of we can get out of this, whether it's 1/8 of a cent, 1/4 cent, half cent, there are going to be times when it's 1.5 pennies. It'll pay for your brokerage and you'll be in these options for free. This is what we're looking for. So what we've done here is we've created a synthetic long call, knowing that the call is worth 40 cents. We created it by buying a future and buying a put, and we were able to create a synthetic position in the calls at 5 cents cheaper than they're trading in the pit. Or, sorry, on the screen. I mean, it used to be in the pit, and now it's the screen. Now we're going to go into, this may seem a little bit dry, but it's not. You're going to really need this stuff. Being able to figure out the price of one with the other two components, okay? If the futures were trading, we're not going to use at the money anymore. So let's get our mind away from always using at the money. I use at the money just because that's the easiest example for you to go through. Now we're going to use on the money stuff and in the money stuff. So if the futures are trading, we'll call the futures 1342, and we know that the put, the $13 put, is 8 cents. What is a $13 call? Okay, first of all, which one has the higher delta? Which one has the lower delta? Well, you can look at the futures at $13.42 and look at the strike. The strike price, the calls are in the money. The futures are above the strike price. So we know the $13 call is the one that has the intrinsic value. And the $13 put has the only the time value. So we have 42 cents of intrinsic value plus 8 cents of time value, which equals 50. That tells us how much the call is. So now we know what the call and the put are. If the put starts to have order flow coming in and it starts to be selling the puts down to where they're trading only 7 cents, order flow will dictate these opportunities that come along with synthetics. And you're trying to buy deltas for your position, or you're just, for some reason, there's a lot of different reasons. You would want to be long that call. And this put gets offered at 7 cents in the pit. You were going to want to buy that put, and you're going to want to buy the futures. As long as you can buy the futures at $13.42, that will give you what in that synthetic call. Well, it'll take the time value down to 7 plus your 42. You're going to be buying that call at 49 cents. That's the synthetic that you're going to use to whether to even up your position, either delta-wise. And when I was talking about delta-wise, for some reason, you got short and you're scrambling and you're looking for ways to get long. These are the best ways to do it. When you're under the gun, you're like, okay, well, these calls are really hard to buy. Everybody's looking to buy calls. Everybody, calls are bid all over the place. The best way to do it is to trade the puts. Another reason why these synthetics are really important, and this will help you guys a lot, and you can use it in any strike. You'll hear people talk about markets when they go lock limit bid, lock limit offer, and nobody knows where the futures are. This is when your synthetics are going to come in really, really, really important, because you're not going to get, everything's not going to line up, and this is where this is where the most opportunity is with synthetics also, because everything's not going to line up just perfectly. So let's say the market goes locked limit bid. Now I'm gonna go back and define this. I'm not trying to insult anybody. I just want everybody to understand what locked limit bid means. So the exchange sets a daily limit that the market can trade for order purposes, so that they can control, chaos in the markets. So let's say that on this day, the limit for soybeans to trade in any one given day is 50 cents higher. And let's say they start at $12.75 to start the day, and they go lock limit bid. So they go all the way up to $13.25. Okay? At $13.25, you'll start hearing people talk about the pool. So the pool would be, 3,000 were bid for at $13.25. That pool says there's 3,000 contracts wanted for at $13.25. Now you're scrambling, or let's do it the other way. Let's not say you're scrambling. Let's say you're long. and you just want to take profits. But you don't want to just sell 13.25. There's 3,000 bid there for. You might be able to get a better price. How do we find out what the better price is? Well, the first thing we do is we look at the 13.20 calls and the 13.20 puts. Okay? And we notice that the 13.20 calls are trading 32 cents. And we notice that the 13.20 puts are trading 11 cents. Okay? Right, okay. Well, we know what to do because we know how to trade synthetics, and we know how to figure out where futures really are, even though they're locked limit at $13.25. We know that they're synthetically trading at a different price. And you'll have people, you'll have brokers calling you all the time. Now that you know, hey, do you know where the futures are trading? Absolutely you do. Because we, with our synthetics, we are now able to determine where the market is actually trading these futures, even though the futures have stopped trading at $13.25. We know where they're trading synthetically. And where are they trading synthetically? Well, if we bought a call at 32 cents, and we sold a put at 11 cents, what is the difference? The difference is 21 cents, right? Now, what is the delta of a short put at the money? It's a long 0.5. What is the delta of a long call at the money? Long 0.5. Even though these things are not at the money, the call's 5 cents in the money. Let's say that delta is 55. What is the delta of the put? It's 45. It doesn't matter. It's always going to add up to 1. It's always going to give you the synthetic price. So the difference is 21 cents. Now let's break it down. The futures prices are above the strike price. How much, what is it? So that makes the call in the money. So what is the intrinsic value and who does it belong to? The intrinsic value is 21 cents. And it belongs to the call because the call strike price is below the futures price. So if we add the 21 cents to the strike price, we know that the futures are actually trading at $13.41. So the futures can be locked limit at $13.25. But as long as we know where the synthetic is, we know where it really is trading. So if we join that pool, we just throw a 10 lot in there, say, I want to buy a 10 at $13.25, and you get hit on it, you turn around and you sell the call and buy the put, you sold the synthetic future at $13.41. You just keep doing that all day long. And it will really, really help you when you're pricing out outright options to know where the futures really are. Because if this is actually trading at these prices, and the prices I gave you are real prices, you can actually buy futures at $13.41 if you need to. And you can sell, obviously you can sell them at $13.41 if you need to also. This is a valid market both ways. And the only way you know that we're trading $13.41 is if you understand these synthetics, because they're going to ask for the synthetic futures price when these markets go locked limit in every single market. And that is a massive advantage to have, knowing where the futures are actually trading. So a lot of times, if you have a position on that you're long the market and you want to take profits and you're ready to sell $13.41, and then the market doesn't open quite as feverish as it was during the day session and opens at $13.35, you've already got a 6 cent head start on where they're opening 10 cents over synthetic. So you're very much more in tune in where the market really is trading if you understand the synthetics. It's not so easy when you are given the futures and the call to understand where the synthetic options are trading. And why is that? Because those futures are not readily tradable. Every time we created those synthetic short puts and long puts and short calls and long puts, we made the assumption that you're going to be able to buy and sell futures freely at the given price that we were using in our examples. When the market's locked limit, you're not able to freely trade those futures. They're locked. They're locked for a reason because everyone wants to buy them. If they come off limit, if they, for some reason you see the pool, and you can watch the pool, it ebbs and flows all the time. If you watch the pool getting down 3,000, 2,000, 1,800, 1,300, 800, 700, 400, 200, 100, then it comes off. People start canceling their bids because they don't really want it. They're just trying to push the market one way. They don't really want to buy it, and that's when they see all those starting to disappear, and it comes off. Now you can start trading synthetic calls and puts, because now you can trade the futures against that. Remember, we have to do this stuff 1-to-1-to-1. If one of those pieces of the puzzle is not available to us, we can't create the third piece. Same thing with the puts and the calls. If there's no put or call, bid or offer, we can't create a synthetic in it because we can't take the other side of it. We need to know what the other side is before we can actually trade the synthetic against the outright, and that's called an arbitrage. And that's what this is when the market trades limit. We're arbitraging the futures price against the synthetics, and when it does happen, you are at a huge advantage to 95% of the people that trade commodities because they don't understand how to figure out where the synthetic is. Now here's a really good one to look at when a market trades limit like this. Again, you guys are at an advantage of this because you understand the delta components of synthetics. Other people don't. So let's say in our example, the market is locked limit at $13.25. Everybody looks at the money. And that's at the money, $13.20. Let me use our example. That synthetic was $13.41, which was a 32-cent call and an 11-cent put. What if we looked at the $13 strike? This is what's really cool. When it's locked limit, stuff gets so mispriced and it's so fun to find them. It's like finding the Easter egg that you're looking for on Easter when as a kid. And so at $13.20, you've decided that, by being able to trade the calls and puts, that the synthetic is trading at $13.41. If we go and we look at the $13 strike, and give me a second here so I get the right numbers so that $13 call and a $13 put. Okay, the $13 put's going to be less money than the $13.20 put, so we'll call that 8 cents. And we will add we'll make this one 45 cents. The $13 call obviously has to be more than $13.20 call, and the $13 put is less than the $13.20 put. So in this example, where is the $13 synthetic trading? Again, one of these components is in the money, which has intrinsic value. Which one is it? In this example, obviously it's a $13 strike. So the $13 call has intrinsic value of 33 cents over the put. So the futures synthetic price of the $13 strike is $13.33. So if you can trade the synthetic $13 strike at $13.33, and you can trade the synthetic $13.20 strike at $13.41, you can bid the $13 synthetic and offer the $13.20 synthetic and make money. If you're stuck and you're looking to buy futures and people just say, well, you can buy them at $13.41 by doing the $13.20 strike, do a little research. Look at deeper delta options and find that in a perfect world, they should all line up at the exact same price. They should all line up at $13.41. But when chaos hits, it's never perfect. And you're going to be able to find strike prices. And it doesn't have to just be in the calls. It might be in the puts. It might be the $14 put. It might be the $15 put. All you guys got to do is go through your synthetics and do it for each individual strike. It might take you 5 or 10 minutes, but it's worth it. If it saves you 8 cents, it saves you $400 a contract, that's pretty good work for 10 minutes. Just go through each strike, and if you're able to say, "Oh my gosh, I can buy synthetics at 13.33 here," even though I know this guy over here is bidding 13.41 through. And when I say this guy, I go back to my pit days, but it's the same thing in the screen. When the screen is bidding the 13.20s conversion, or sorry, synthetic at 13.41, and you're able to buy the $13 one at 13.33, that's a no-brainer. Even if you just want to take the profit, take the profit. If you're stuck and you need the futures, now at least you bought it 8 cents cheaper. Do your homework when these things happen, and you're going to be way ahead of the game. Okay, well, we are halfway through the first course. Hopefully now you see what I was talking about, where it's so important to start with the very basics and build into a vast knowledge of understanding what these things are we're trading and how they're used. So you can see the building blocks of what we're doing. We've taken a basic call and put, and we've defined out, we've had definitions of, being able to speak the language of traders and marketplace people. And we've grown that little knowledge from just understanding what a call is, from the right but not the obligation to buy a certain commodity at a certain time. And we've taken that basic concept, and we've learned how that option is priced, what components go into the make that option worth what it is. And now we've taken that option and we've kind of molded it a little bit more to where we understand how its properties in terms of delta and what component of a future that is. And now we've gotten to what some people will call pretty advanced, a synthetic. We've been able to take a look at what a option, how it relates to the other option, how the call and put relate to one another, and how the call and put relate to the future, and how we can take two of those three components and build the other one. Like I said, there are so many ways to enter and exit a market, and the more tools you have to be able to do that in the most economical way will save you so much money and make you so much more profitable in your farming system or just your speculative account or any other way that you're using the market, whether it's to price, interest rates on land you're looking to purchase, or pay down debt on seed sales that you've already paid for or committed to with the bank. You can use these options in all different ways to make yourself and your family and your operation a lot more profitable. So now, going into the last half of this course, we're going to take the properties of options and we're going to show you how those properties change with the market. You're going to start hearing terms that are synonymous with professional option traders like Vega and Gamma and Delta and Neutral, and how those things are all on a change with the market, and what makes them change, and how to look forward and see, is the marketplace dictating true value for the movement that these options are getting. All this stuff is being built right now, and you're getting the knowledge, and you have the building blocks to be able to handle this next part of where this course is going. It's going to get really exciting. I look forward to the next part.
Wonderful. No, great.